Let's talk about whether or not this slowing momentum is a sign for worry overall. We've seemed to have staved off recession for the better part of a year. Is it going to get worse heading into the fall?
So it's not yet a sign for worry. Right now, labor market indicators have slowed, but only to pretty good levels historically that would represent a hot job seekers market. The question is whether this slowdown will decline. And if this downtrend continues, very soon we could be talking about labor market weakness as a problem.
All right. So, Julia, if that's the case, the labor market weakness is anticipated maybe to be a problem. It hasn't been a problem despite a lot of headwinds over the course of the last almost year at this point. What exactly is it that makes the U.S. job market so resilient and by extension, perhaps arguably, a thorn in the side for the Fed right now?
So the U.S. economy is pretty much dependent on one factor, and that's the U.S. consumer. And to date, the U.S. consumer has remained very resilient and strong. Many people received those stimulus checks and unemployment insurance payments during the pandemic. They paid down debt. They locked in lower mortgage rates. And so they're doing well. And at the same time, they gained jobs. The recent pace of job growth has set off a virtuous cycle in the labor market where people have added income, added jobs, households have gained an earner, and employment to population ratios for prime age workers are the highest in 22 years, the highest ever for women.
If you look at the subtle movements within where jobs are being created and where they're being lost, I remember how many jobs reports I went through and have reported on about how hospitality and leisure pretty much led the way for the better part of the last 2 years for job growth. We're starting to see that decline right now. Is that a worry? Is that a telltale sign about consumer spending or about what consumers are doing with the little money that they have left after those stimulus checks have now started to run a little bit out?
So I think it's a little bit of a reason for concern that the leisure and hospitality sector has not fully recovered, and it looks as though it won't for many months. That said, the share of jobs made up by leisure and hospitality is shifting back to normal, and we're seeing the leading industry for job growth become healthcare again, as it is expected to be over the next decade. So we're really returning to sort of a normal job mix.
And Julia, speaking of that consumer, September 1st, just the fall overall means a return of one thing that many Americans do not want to see return, and that is student loan repayments. It's going to take a chunk out of a lot of people's paychecks because they will have to repay those for the first time in a long time. What exactly is the outlook, and how does that affect the American inflationary story as well?
Sure. So 46 million Americans will be affected by the student loan restart. And yet the aggregate effect on the economy could be smaller than many expect. And that's for several reasons. One, many Americans continued to pay their student loans throughout that forbearance period. Another is that as these headlines about the restart have been all over, many have prepaid their loans and started paying back earlier. Then we also have these new income-driven repayment programs starting. The Biden administration's SAVE program will allow many borrowers not to pay a cent if they earn less than 225% of the poverty line. And so, this is not going to be a massive shock to the economy all at once. It's going to be a slow burn.